So this is the next video lesson following on from what we've done with cash flow forecast. So this next chapter is setting budgets. You can move on from this, have confidence in it as a topic if you can fulfill the following lesson objectives. So you need to understand what a budget is and why businesses use them. You need to understand what makes an effective budget. And you also need to understand the different types of budget that you might come across when looking at a business. So what this topic is all about, setting budgets is a key part of the management and financial control for a startup business. Budgeting is part of business planning. It's about allocating the limited amount of resources that the business has, and it gets used to monitor performance and, if necessary, take corrective action if things aren't going to plan. So the first thing you're going to need is a definition, whether you get a 2-mark question asking what is a budget, or whether it's at the start of an essay question, you need to be able to give a correct definition for what is a budget. So, a financial plan for the future concerning revenues and costs of a business. The bits in red are key there for properly establishing with the examiner that you have a proper understanding of what a budget is. Obviously, if you're able to convey an understanding that doesn't cover that word for word, then that is fine. But if you are in doubt, that is your go-to definition for what is a budget. So, there's a process that you have to go through for setting a budget overall for your business. First thing you need to look at is what are you trying to achieve with the budget. And once you've set objectives, targets for what you want to achieve, you can then go on and carry out your market research. This will help you discover what your likely levels of sales are and what price you can expect to charge for the product, or if you have several products that are available to customers. You can then from that complete a sales income budget. So this will tell you how much money is going to come in from the level of sales that you're expecting. Once you know how many sales you're likely to make, you can carry out research into costs. So if you know you're going to sell 100 units a month, you can work out how much it's going to cost you to produce those 100 units. From that, you can construct an expenditure budget, and this will explain the costs that the business is going to incur in achieving the level of sales that the market research suggests they're going to do. You can then combine the two to create an overall profit budget. You take the sales budget, add it to the expenditure budget, and that will give you a profit budget. Don't get this confused with the cash flow forecast. This is not money in, money out. This is expected sales, revenue, and costs. If the business is quite big and it has certain departments, you might draw up a divisional or departmental budget. This will be done by the managers responsible in each area. In Unit 1, it's a bit unlikely that this is going to happen because it's a startup business. You then summarise the detailed budgets into one master budget. That would be the overall how much money is available, how much is going to come in, how much you're planning to spend. So what makes an effective budget? The most important thing to do is to estimate sales reasonably and accurately. You mustn't be too optimistic, and as much as possible it must be based on your market research. The other thing is to estimate your costs prudently and precisely. You need to be cautious in your assumptions and check as much as you can that you have considered everything that you might have as a cost for operating your business. So why do businesses use budgets? Using a budget means you're able to measure whether key objectives and targets are being achieved. It's also an excellent way to control expenditure by allocating who can spend what. We call these people budget holders. So if you want to give a particular amount of money over to advertising, you can say here's a fixed amount and that is all they have in the budget to spend on advertising. It should provide a sense of direction, focus and targets. Whereas forecasts, cash flow forecasts were a prediction last month, this is very much a plan that you're trying to follow. And with that plan, you can then monitor actual results against the budget to see if you're doing better or worse than you thought you were going to do. So the first of the budgets we're going to look at is the sales budget. Putting a sales budget together is often quite hard for a startup if you don't have any previous experience in the market. And remember, your Unit 1 case study will talk about what the entrepreneur did before they chose to start this business. Because you're brand new, you have no existing customer or sales history, so you have to predict sales volumes and what prices you're going to be able to charge. Sales budgets need to take into account the market research. This keeps coming up because it's so important. This is vital in taking a realistic view on sales volumes and prices. Assumptions made about the timing of sales are also important and where they will come from. In cash flow forecasting, we said that one of the most important things was about when money came into the business. Again, that's important here. When are customers going to pay? When are you going to make sales? Are there going to be seasonal peaks and troughs that mean money isn't coming in a consistent level? So, in this first example, we've got a total sales budget that's been prepared for the year. So, as we're working out revenue, sales are calculated by multiplying budgeted sales volumes by budgeted selling price. So, in our example here, we have a company selling gas boilers. They do installations, repairs, and maintenance. So, we've got quantity sold times selling price, and that's giving us the total revenue. We talk about it here as being sales income, so this is a sales budget. Again, remember I talked about how revenue, sales, income, turnover all essentially meant the same thing. In this different example, the budget has been prepared on a monthly basis. So they sell two products in this example, product A, product B, and we've got total sales for each month and then a total revenue for the 6-month period. So after your sales budget, you've worked out what volumes, how many you're going to sell of your product, you can then look at expenditure. The expenditure budget is vital. You're likely to incur costs before you actually start selling anything. You must ensure that there is sufficient cash to pay for the costs. As we talked about before, poor control of costs that leads to cash flow problems can lead to business failure. It is the most common reason businesses fail. Ideally, the expenditure budget needs to be prepared in as much detail as possible. Your overall objective with this one is that it needs to be complete and prudent. You must be cautious and you must have as much detail on it as you possibly can. Key areas for a startup in the expenditure budget. These are the main categories of costs that are likely to be included in a startup business's expenditure budget. So, cost of premises, rent, rates and insurance, any staff costs you might have, heat, lighting, other energy, other location related costs, i.e. office services charges or warehouse rental, any equipment costs, computer, software licenses, things like that. You'll have to spend money on marketing, both for your launch and ongoing marketing, advertising and promotions. You might have to pay commissions and royalties to any salespeople that you have or any distributors of your items. You'll have travel and subsistence costs, just general costs for getting around and surviving day to day. You might have legal or professional charges. If you've used any consultants and advisors to help you with your cash flow forecasting, with your budgeting, whatever, then you will have charges that you have to pay to people who are not employees. The company, if you've started up a company, you may have company formation costs for registering with Companies House. These are all things that need to be considered whether they are relevant when setting up an expenditure budget. So, prudence and completeness, just a bit of explanation about what this means. Prudent means that budgets should be sensible and they should contain cautious assumptions. Don't be too optimistic on sales, allow some contingency for budgeted costs. That means leave a little bit of room in case your costs are higher than you think they're going to be. Complete simply means knowing and including everything that you possibly can. It needs to be prepared in as much detail as possible with nothing missing. The worst thing you can do is prepare a budget, think you have money available because you've overlooked an expense that you've got. Here's an example of an expenditure budget. Each month showing all the costs that are going out of the business and totals for the month with a total for that 6-month period. So a profit budget is a combination of the two. Sales is revenue coming in, expenditure is cost going out, so if you combine the two together, you should be able to come up with the profit figures. In this example, the profit budget shows a business making a loss in May and June because the total costs are greater than the total sales, but a profit overall. So as you can see, in May, costs exceed sales, same again in June, but overall, they actually make an £11,000 profit. This is why putting these budgets together is important, because if you didn't have a plan, you might find yourself in this situation in the first couple of months of trading and think that everything's going badly, whereas if you've got a plan to stick to, even if you have had a couple of unprofitable months, you know that the bigger picture is that ultimately you will, over this period, make a profit. So, methods for setting a budget. Remember, in Unit 1 we are dealing with start-up businesses. The entrepreneur has a lot of things that they've got to take care of. They don't have a lot of time and they don't have unlimited resources. It is not possible for them to have a look back at what happened previously. The budget needs to be an integrated part of the overall planning of the business. You don't want to crucify the entrepreneur in your answers because they haven't spent hours and hours and hours preparing a budget. It is a small part of general business planning for the startup business. Some basic tips to go alongside those ideas. Make use of rules of thumb. It's a good idea in most businesses to hope for a gross profit margin of 50%. In other words, whatever it's cost you to produce the item, charge double that. It's important to speak to customers and suppliers so that you understand the market works as best as you possibly can. You should make use of advisors and consultants. There are many free business planning guides available which can help you produce a prudent and complete budget. As with cash flow forecasting, using experts is a good way of improving your chances of doing it effectively. The entrepreneur needs to accept that the first year's budget is going to include some guesstimates and hunches, so there should be some flexibility for contingency. Contingency means having a plan for if things go wrong. This means leaving some money over in the budget in case costs are worse than you think or sales are less than you think. Last tip is revise the budget as the year progresses. Go back, look at your main assumptions, particularly on sales. If you're not selling as much as you thought you were, go back and change the budget. If you're selling more than you'd hoped, go back and you can change the budget. Continue to be cautious, but you can make changes to it. Okay, setting budgets is all well and good, but there are certain limitations to it. Because they are based on estimates and assumptions, actual results will always turn out to be different. You will never be completely bang on with a budget. Startups have no trading history. That makes setting the budget much more difficult. Setting and monitoring the budget takes time. It shouldn't get in the way of trying to build the business. So again, if the entrepreneur has not spent all that much time on setting up budgets, that is not a big deal. They are very busy. They've got lots of jobs to do. Budgets have a limited motivational effect, particularly if the startup doesn't have any employees. The bigger a business you are, the more staff you've got, the more useful budgets are from a motivational point of view. If it is just you as an entrepreneur, you don't need to be motivated by having to stick to a budget because everything's already invested into the business. So, general exam tips. Remember that for the startup entrepreneur, the time spent setting and monitoring budgets has an opportunity cost. If you spend 3 days working on a budget spreadsheet, you could have spent that instead on visiting customers, training staff, or developing new products. As a result, an effective budget system for a startup is likely to be pretty simple. Often nothing more than a single spreadsheet, just as a guide, something for the bank to look at. Don't be too critical of the entrepreneur in the case study if they find it hard to summon the enthusiasm for a complex budget. It's just a small part of the business planning process. So when you're presented with your case study, remember, budgeting can be important, but for the startup business, again, it's a difficult thing to do. Hopefully this has given you some help with those lesson objectives at the beginning. You should have completed the sheet now, gone through everything, prepared a list of questions for when you come to the next lesson.